This is TreppWire Week in Review for the week ending May 26th. I'm Haley Keene with Trepp. I'm here with Lonnie Hendry, SVP, Head of CRE and Advisory Services, and Dr. Stephen Bushbaum, Research Director at Trepp.
And we are live at the NAIOP Silicon Valley Capital Markets event in California.
This week, we are doing a deep dive on Silicon Valley, but we'll also be reflecting on the macroeconomic turmoil that has been impacting commercial real estate nationally. I know in recent months and recent weeks, our heads have had to bounce back and forth between thinking about the Fed's decision on interest rates, bank turmoil and deposits, and now debt ceiling negotiations. So with all of that, we're all trying to make sense of commercial property performance. So Lonnie, why don't you start by diving into what we're watching?
Yeah, so I think you bring up a couple of interesting nuggets for us, Haley, this week. If you had asked me the question on the macro scene last week, the debt ceiling was top of mind for everyone, and it looked like we were basically running towards an agreement. We were going to be able to announce it, put a banner up, and everyone was going to be happy. Come to this last weekend, we hit an impasse, and here we are, midweek of the following week, still no resolution in sight. So, Janet Yellen has come on record and said June 1st is kind of the drop-dead date. If there's not a debt ceiling deal, the U.S. government has potential to start defaulting on obligations. I think that's a little bit of hyperbole in the sense that they'll probably just start prioritizing payments. If we don't have a deal by June 1st, they won't go into a full default. But as the U.S., as a country, we don't want to see anything related to default attached to our name. So I think that's something we're still keeping an eye on. It is political in nature, though, so we don't really know what's real and what's not real. So some of this could just be posturing. In every other debt ceiling crisis, they've always reached an agreement, usually just increase the limit. I assume something like that will happen again. But that's something I think we're definitely keeping an eye on. The corporate earnings, we had corporate earnings on the retail sector over the last couple of weeks. On the whole, corporate earnings were actually really well received in the market and up. Target, Walmart, were at or beat expectations. Home Depot was kind of a surprise. They saw negative earnings, and the market really reacted in a negative way. They revised their outlook for the rest of the year. And the bank deposit volatility, I know Stephen's going to talk a lot today about some of the banking news, but it's still not settled. We've had a couple of bank failures. The general consensus is that maybe the worst is behind us, but I would maybe take a contrarian approach and say I think there's still more pain to come in the banking sector. It's just going to take some time to play out. And deposit movement, deposit volatility has really been a leading driver of some of the bank failures. And until we get that sorted out, I think we're going to have some challenges. So, a lot of headwinds, but I still think some opportunity. So we have some information here around Silicon Valley at a region level. Unemployment here is at 3.1%, which is significantly better than the national average. It's up 0.1% since last year. So we've seen some upward movement in unemployment, which I think the Fed is monitoring. You mentioned the Fed. Waller came out today and said, don't assume that rates have paused. He actually said he thinks that we're going to see 2 more rate increases by the end of this year. So it'll be very interesting to see how those dynamics play out. Unemployment is one of the things they're looking at in addition to inflation to determine what they're going to do with rates. GDP growth has been good here. Some negative news for the Valley. Office vacancy, pretty significantly negatively impact, 15.5% in Silicon Valley. And if you look at San Francisco specifically, hovering around 30%. We have some other information we'll talk about in a little bit later. So we had a couple of other things, and Stephen, I'll get your input on this in terms of just general strength of the region. So, when we do a deep dive, this is our second live podcast recording. We did one about a month ago in Detroit. Very similar story. Detroit at one point in the U.S. was a huge economic engine, driver of innovation, creator of jobs. It's fallen on some hard times over the last few decades. People are trying to draw a comparison between Detroit and Silicon Valley. I'm not buying it. If you look at some of the office data, it's really negative right now. But if you look at the underlying fundamentals here, Silicon Valley is poised for a rebirth. We got AI, we have all these new technologies that are just barely being introduced into the marketplace. And if I were taking a long position, Silicon Valley is going to be a driver of that innovation into the future. So we think there are 3 pillars of promising themes of why Silicon Valley will see a rebirth. It's the center of innovation. If you look at VC money, it's the largest by far. 80% of VC money in the U.S. is in the Silicon Valley, 7 times the size of the next largest VC hub. the talent pool with Stanford, UC Berkeley, and others, you can't replicate that other places. I mean, places have tried, but the reality is you guys have a huge competitive advantage in the market, and just overall resiliency, global culture, diversity, enterprising, entrepreneurialism. Those are skills that you can't teach at scale, and you guys have a 50-year head start on everyone else in the market. So, I'm bullish on San Francisco, Santa Clara, Silicon Valley in general. We have a couple of other identified markets that we think are poised for reposition: Vancouver, San Diego, Boston, and Raleigh-Durham. So that is going to take some market share. The Raleigh-Durham, as an example, kind of come on the scene in the last 10 years. Austin could probably be thrown in that mix as well, but I don't think it negatively impacts market share for the valley here.
Yeah, I think the economies of scale of innovation that you get in Silicon Valley really are second to none, and that's where I think a fundamental strength of the market lies. And what will be really interesting to watch is the dynamic of what happens with, say, downtown San Francisco versus the greater Bay Area. But I think just imagining longer term, some of the things that we could see come out of this. I used to lecture all the time on urban structure to my students, and for about a decade now, I've had the longstanding belief that autonomous vehicles will really reshape urban design and location preferences among individuals. Traffic congestion really does drive, to a large extent, migration patterns within a metro, across metros. So I think what'll be really interesting to see, being that we're at the epicenter of autonomous vehicle innovation, is really what comes out of that, right? If you're thinking of capital allocations and land plays over the long run, I would be much more bullish on the suburban locations that can benefit from, say, commutes that currently might be 45 minutes to an hour, that all of a sudden get reduced to 20 to 30 minutes, and are a lot less stressful, right? That's a very, I think, real driver of migration patterns and ultimately urban design that is really, might be a little bit hard to imagine exactly what form it takes today, but will have very real implications for how some of these markets develop over the next 10, 15, 20 years. And importantly, I think that autonomous vehicle adoption is going to be a lot quicker than what most people would think. I still think by around 2030 is where we'll see some critical mass and real changes in terms of commute times and the development patterns that result in that. Obviously, there will be some challenges for electrical grid structure and regulation, things like that. But at the end of the day, as we've seen from the AI innovation push, that's really what makes me believe at my core that this will be quicker than what we might have anticipated 5 years ago.
Yeah, I think this week I saw Waymo and Uber made a strategic partnership announcement. So, there'll be definitely more to come on that. You can sign me up as a beta user there. I have an hour and a half commute daily, $50 in tolls, about $600 a month in tolls. So if anyone wants to, sign me up for autonomous vehicle training or whatever, I'm happy to be a test subject. Yeah, in Texas, where I'm at, there's really no mass transit option. It's kind of like just get in your car and drive and drive and drive and drive some more. So I'm used to that, but I would be a supporter of the autonomous car, because then I could just work in the back seat. It can't all be roses. We definitely think the Silicon Valley area is poised for a rebirth, and we're long, the marketplace here. But there have definitely been some challenges that we've seen over the last couple of years, and some of them have progressively gotten worse. Now, I will say the headlines make things seem a lot worse than they are in reality in a lot of instances. But if you look at the fundamentals, that drive real estate, supply and demand, work from home, behavioral shift, there's been a lot of things that undermine, some of the core property types in the marketplace. And so a couple of notes here: tech layoffs, Google, Meta, Microsoft, Salesforce, there's a lot of tech layoffs. And so unlike other recessions where we've gone into it and you've seen blue collar workers lose their jobs first, this has really impacted the high-earning, white-collar workers in the tech industry specifically. So we haven't seen that cascade down yet, although it's potential to do that with rate increases and some of these other things we've talked about. If you look at return to office, Silicon Valley, San Francisco lagged other locations. And so I think even today, if you look at the Castle Systems report or you look at some of these other metrics that try to look at building utilization, this region is still less than a lot of others. Is that something that's going to be pervasive long term? I don't know. Out-migration, I think that's something as a state, California's really had to deal with. Where I'm from in Texas, we benefited from all the California folks moving there. We've had one of the largest net in-migrations. It's great unless you want to buy a home in Texas, and now the prices have been driven up crazy. Same thing in Florida. A lot of New Yorkers have moved from New York down to Florida, and it's really increased housing costs. A couple of other considerations, and Stephen, you can interject here. City and county tax revenues, I don't think we've really anticipated or fully modeled out what that could look like. I know with Prop 13 in California, the tax base is relatively stable because reassessments are kind of baked in unless there's a transfer. But with Prop 8 appeals on wanting to be revalued lower when you can make a case, or buildings transacting at 20% of what they sold for 4 years ago, and then locking in that new sales price and then 2% escalations, it's going to have a real erosion on the tax base. And I don't know how wide or how far that implicates other city services and other governmental providers of service that we're all used to receiving, how far those budget deficits potentially reach. But one estimate we saw, San Francisco is on track to potentially lose about $80 million a year, and that's with where we're at now. If offices start retrading at scale at 50 cents on the dollar, it's going to be way worse than that.
Yeah, I think the dynamic you have in the interplay between the story around taxes, crime, high cost of living, those are three themes that when we're looking at the data points across metros that you see in common across the areas that have been hardest hit, or conversely the areas that are performing the best right now. The possibility that there could be a municipal default on bonds that could ultimately roll down to services provided, and the viability or certainly the timeline of any rebound is a very difficult thing to wrap your mind around. And at some level, I think, interestingly, this would also tie back to the government story and the push for return to office there. Because when you have really the largest single tenant in the nation, still having a very flexible remote work policy, it's hard to push back at the private level too much. So it'll be very interesting to see if the government ultimately makes that connection between, well, we could bail out some of the banks for credit losses on their portfolio because of the knock-on effects of remote work, or we could push our employees to return to office in some meaningful numbers. It's not that straightforward of a trade-off, but at the end of the day, there are certainly two elements there that will have some very real implications here over the next 12 to 24 months.
Yeah, and that's a story that's not where everything's created equal. If you look at DC as an example, the primary office worker there is government related. And because they're allowing work from home, multifamily, retail, restaurants, they're all suffering the downstream consequences of those office workers not being in the city. LA is very similar, a very large concentration of government office population. Those workers not being in the central city create a lot of other downstream implications. And so it's really interesting. If you look at New York, Chicago, LA, San Francisco, kind of gateway cities over the last 15 years, those cities have disproportionately been impacted by some of these things relative to other secondary and tertiary cities that have actually kind of built a suburban work culture. And so they've been able to navigate this without some of those, devastating headlines.
So let's turn to some of the data. We've been talking about banks at a high level, but we've really been tracking some of the distress, the concentration levels at banks, and really the factors behind some of the collapses. So Stephen, why don't you tell us what you're watching?
So the flood of money into the system from government stimulus during the pandemic was, I think, front and center, a core theme to what we saw play out in the banking sector, and that we've seen massive deposit growth at a number of these institutions, and well, you can only make loans at a given clip, right? We can't put all of that money to work in residential and commercial loans right away. And so where Silicon Valley Bank and a number of others got into trouble was they put a lot of it into longer duration treasury and commercial and residential mortgage-backed securities. Basically, you have short-term deposits and long-term assets. You would have thought we would have learned this lesson in the 1980s. I think all of my students that had to suffer through my 2-week lecture on the S&L thrift crisis of the 1980s probably appreciate that time a little bit more now, I hope, if they remembered it anyway. The asset-liability duration mismatch was an incredibly painful one, exacerbated by the accounting rules that we had, and that you didn't have to just mark to market those securities, you could move them over to the hold to maturity. And so you had these unrealized losses that were building up in the portfolio, combined with the Level of uninsured deposits, and importantly, the stability of the deposits is what we've learned wasn't stress tested probably enough or thoughtfully enough. The advent of banking apps and social media really played a major role. And so if we looked at, say, let's make the cutoff at 2010 and earlier, the maximum drawdown for a bank in its history wouldn't have even come close to what you could see today. And so that liquidity need over a 30-day funding period ultimately broke the backs of many of these institutions. And will be interesting to see how the stress testing changes going forward for the assumptions around your deposit drawdowns and liquidity need. And what's concerning, and what Lonnie mentioned earlier about, well, nothing's really changed. So we want to believe that the banking turmoil is behind us, but still, when we have 3 of the 5 largest bank failures in history occurring this year, you have to wonder how many more might be out there. And so the lending portfolios combined with the liquidity analysis, I think is what we'll talk about on the next slide, that are really key to understanding what kind of stability we have in the banking system. So fortunately, we have a Bank Navigator product that's pulling information from call reports. They give us some good insight into what's a 6-factor analysis. So if you ever hear the term CAMELS, that's the 6 risk factor analysis between capital, assets, management, earnings, liquidity, and sensitivity. So if we're looking at First Republic's collapse by the numbers, you can see sensitivity, liquidity, and earnings all had risk scores of 4 or above. And off the top of my head, I believe it was around a little bit above 50 institutions out there in the marketplace have risk ratings equal to that, so 4 or greater across those 3 metrics. So again, it's great that it's not in the hundreds, but it's certainly a non-negligible number when we think of the banking sector stability and what could play out if we do see more drawdowns. So the large deposit growth was a big factor. Turning to the net interest margin, I think this is one that'll be interesting to watch going forward, because we're entering a phase where the fight for deposits will be more competitive. Depositors will go to get yield if they're not getting it from their bank. And that kind of power in the margins could force some institutions to necessitate recapitalization if they start seeing drawdowns 5-10%. Because what we don't show here is the loan-to-deposit ratio and the CRE and construction loan concentration ratios for some of these institutions are at the upper end of the spectrum when it comes to risk. So if your loan-to-deposit ratio is above 90%, it certainly is a little bit of a liquidity concern. That's what we just don't know yet. That still is playing out, but why at least we're healthy skeptics about turmoil being behind us, because really nothing has changed in essence. So unless we get, say, a cut in rates later in the year, like what's being priced in, that pressure is still there, still very real. And to the extent the Fed, FDIC, OCC stress tests will be focusing in on commercial real estate, where we know credit losses are coming through across the board, across lender types. I think that's certainly concerning for debt liquidity going forward.
I know yesterday we had an announcement that one of the banks sold off their new construction portfolio at about an 8% discount, which all things considered probably a pretty fair trade on their side to take a little bit of a haircut, and maybe the buyer's getting some upside there. But to your point, there's a lot of risk built into the system right now that just hasn't fully fleshed itself out. So we put out a lot of research over the last couple of weeks concerning some of these metrics. So for anyone in attendance today or anyone that's listening to the podcast, you can reach out at podcast@trepp.com. We're more than happy to give you a copy of those reports for free. A little bit deeper dive. I know this is a lot of information to digest in a very quick podcast setting. But the reality is the banking system, as Stephen mentioned, a bank run today looks a lot different than a bank run on deposits 20 years ago. All of us right now can pull out our phone and transfer money in real time to whatever institution we want. That wasn't available before. And now it just exponentially increases the pace and the scale in which they take place. And so it's really, really interesting times to be a lender. We need liquidity, we need transactions to continue to happen, because we've seen what happened coming out of the great financial crisis when liquidity dried up and no transactions happened. It takes like 5 years to get back on plane. we've kind of seen the other end of the spectrum here with so much money being pumped into the system. That creates another set of challenges, which we've seen. I think Stephen's going to walk us through here some of the market share that's been taken by the regional and community banks relative to what their market share was in the past. And I think it'll give us some good insight into why we're in the position we are with some of these regional banks.
Yeah. So post-2008 financial crisis, we saw a pretty strong shift in asset allocations between the large, medium, and small-sized banks, and that the large institutions really became smaller players in the relative scheme of the marketplace for commercial real estate lending. And it's really in the mid and small-sized banks that have taken up a lot of that slack. It aligns very, very well with their business plan and the relationship lending, their local market knowledge, ability to underwrite appropriately, and ultimately tackle some of the risks that are localized in nature and perhaps are a little bit more difficult or expensive for a national bank to screen without significant teams on the ground in these markets. And we see that in the share of funding that they took up over the last couple of years, but that's also part of the concern here. So to pause here, one of the things that I would say makes me a little bit uncomfortable in the current macro environment is the Fed saying that the credit contraction in the banking sector will substitute for 1 to 2 rate hikes. Well, that's not a policy tool they exactly have, I would say, strong control over, any control over whatsoever. But the fact that they're treating it as at least a policy consideration, A, tells you the magnitude of the issue at hand, but B, also what could go wrong if, I don't know, it ends up being worse than they expect. Because what we have seen is a pretty strong pullback in lending across the board. And what we'll be watching the rest of this year as the numbers come in from the Fed flow of funds, from our taller bank data set. It's a consortium of banks that contribute loan level data quarterly and give us very granular insights at the loan level in terms of the credit trends and origination trends that we see from this consortium of banks. So it gives us a level of granularity that you won't get from the aggregate data, either from the Federal Reserve or the call reports. And we'll be watching that over the rest of this year to see exactly where, when we think of in lending, in these sort of market turmoil points, lenders will pick their spots. And so it'll be really important to see who's picking what spots, like what the leverage points are that institutions are comfortable with putting out there. Because if we go back to the 2007-08 financial crisis, I worked in the life insurance industry on the investment management side, starting out my career. And one of the things that I always thought was really interesting to look at and reflect on was the weighted average loan-to-value ratio of life company originations trending up to 2007, and then the response over 2009 to 12, and how much really got pulled back. So going into 07, the weighted average LTV was around 71%, and that dropped to around 55 to 59% in the years following. And if you think of the current day environment relative to 2007, in the recovery in 2011, 2012, I remember sitting on an asset allocation committee, and the head of the life insurance real estate portfolio was saying, we need to wave in all of the 50 to 55% lodging mortgages we can get at this point. This is trough. Wave them in. We'll take them. And so, what's that going to look like, say, a year from now, and what sort of loans have been really pushed aside by the market, but provide great spread opportunities for the rebound. Office, we're certainly not there yet, but I think eventually we will get to that point where, as we start seeing revaluations on distressed mortgages come through, transaction volume pick up, we'll get better transparency and certainty around the trajectory and ultimate trough of this sector, I hope, which will give us the confidence to underwrite those 5-10-year pro formas and ultimately get some liquidity back in the system for the hard-hit asset classes.
If you look at the office market in particular, there's not an appetite for that at all in the marketplace right now. And if I'm a lender, why would I make a loan on an office property if I have other options? So I think you're going to see a continued growth in industrial. Multifamily, even though it's shown some cracks recently, is still a preferred asset class. And lodging, which a couple of years ago no one would touch coming out of COVID, seems to be making a little bit of a rebound. We've talked on the podcast the last couple of weeks. Retail's really made a strong comeback after COVID and kind of stabilized as an asset class. But for the office sector, I always chuckle internally when we start talking about weighted average LTVs and other things. If we had talked to anybody in the lending space 18 months ago, they would have told you underwriting standards have never been tighter, loan to values have never been lower. Well, yeah, it's because interest rates are zero and values are to the moon. And so, yeah, like if your value is way up here, guess what? Your loan to value can be manipulated down. When interest rates go to 5, 6, 7, 9%, guess what happens to value? It's just math. The value comes down. In the Bay Area specifically, a lot of different banks with exposure to this marketplace that do a lot of lending in this area. And you can see how that composition between the U.S. and the Bay Area relative to bank size and how that looks across the spectrum.
It is interesting to see just how much more share the large banks take up in the Bay Area. And to a certain extent, that's actually really fantastic news because, well, the large banks are, at least as it looks today, only getting larger. There's probably more consolidation to come, at least a little bit, I would say. But the strength, say like JP Morgan, for example, having that sort of balance sheet strength, the fortress, if you will, should help buffer the Bay Area from some of the liquidity and credit contraction that we'll see across the nation going forward.
And for those listening that aren't here in person, we're showing a chart. So in the U.S. on the whole, about 21% of lending is done by banks of greater than $250 billion or more in assets. To compare that to the Bay Area, about 43%. So the Bay Area is about 2 times the composition of the broader U.S. market. And then the contraction in the Bay Area is about 16% of the lender space is absorbed by banks with less than $10 billion, whereas in the U.S. it's about 36%. So you're seeing at the both end of the spectrum, really small banks have a larger proportion of lending across the U.S. than in the Bay Area, and then the big 4 banks really are dominating the lending space here in the Bay Area. We've tried to look at delinquency in other tech cities and other tech hubs because we think there's definitely some insights to be drawn from other markets. And are some of the challenges that are currently being faced in Silicon Valley limited to just Silicon Valley, or are these more systemic across other tech hubs? And so we've kind of walked through and looked at delinquency percentages across the marketplace. And so if you look at Washington, about 6.3%, we talked about that a little bit earlier, driven largely due to work from home and flexible work schedules for government workers. San Francisco's hovering about 3.5%. These are office loans that have delinquencies of greater than 30 days. So in the securitized universe, if you miss your first mortgage payment, you go into what's called a grace period status. You don't technically become delinquent until you've missed the second mortgage payment. So when we say something's 30 days delinquent, they've effectively missed 2 mortgage payments. And so in this percentage, we're looking at 3.5% for San Francisco. New York is third at 1.3%. Then you have Boston, LA, San Jose, Seattle, and Austin specific that are less but registering. And so here, San Francisco, the trajectory is not great. Over the last couple of months, you've seen a really steep increase, and I think you'll continue to see that over the coming months. We do have a topic and slide we'll cover in a moment that talks about overall delinquency. And office delinquencies hovered around 2.5%. Even to run some preliminary numbers, I think it's about 4% in May on the whole. So this narrative of delinquency and office distress, we're very, very early in that cycle.
For a while now, we keep thinking, like, when are we going to see this material uptick in distress? And ultimately, enough of these loans are cash flow positive that you shouldn't see a transition to non-performing status or delinquent status until you hit maturity. And the second quarter of this year was a very, very heavy maturity quarter. Fourth quarter is actually going to be even larger. And so if we're going to narrow it down to what the trajectory is going to look like, yes, as Lonnie said, we're looking at about 130 basis point uptick in the delinquency rate, going from the high 2% to around 4.2, 4.3% possibly, because of that maturity roll. And just as a quick side note, so Lonnie mentioned the grace period distinction of that's not yet rolling into the delinquency number. The same thing happens for maturity. So when a loan hits its maturity date, if it doesn't pay off, it'll have one of 2 statuses assigned to it. Performing maturity balloon, which just means that the borrower is continuing to make payments on its regularly scheduled basis, even though the loan is at or past its maturity date, or non-performing maturity balloon. So the delinquency numbers we show here, and we'll publicize anywhere you'll read, the non-performing maturity balloons are included in that delinquency percentage. The performing maturity balloons are not. So just as fair warning here, going forward, you will probably see a lot of noise in the delinquency rate because loans, when they hit their maturity date, do tend to bounce between performing and non-performing maturity status as that negotiation game plays out. Because the borrower has to show effectively some level of distress to get the special servicer to engage and work out renegotiations. The playbook from 2007-8 was the extend and pretend game, if you remember, where you have borrowers have to kick in an upfront fee just for the workout documentation and the labor side of the equation, and then to what extent possible contribute equity or cash to mitigate any of the material risks facing that property. So if there's significant lease roll, deferred maintenance, there'll have to be reserves set aside for that. If the leverage point is just too high for the numbers to make sense from the special servicing side, obviously a pay down will be to everybody's best interest to de-lever that a little bit. Well, I say everybody's. The borrower might not like it, but at the end of the day, if they have a vested interest in maintaining equity ownership there, obviously that's just the cost of skin in the game to continue playing.
Yeah, so I did check the domain cashinrefi.com, and someone does own it, unfortunately, because I thought I was going to make a killing on cashinrefi.com. Unfortunately, someone beat me to it. We're looking at risk ratings. I mean, the narrative here is pretty similar. We're seeing an uptick in delinquency. We're seeing an uptick in layoffs. We're seeing an uptick in store closures on the retail side. Well, guess what? That translates into higher risk ratings when the lender's looking at their book. So what a risk rating for us means is we standardize risk ratings from our taller consortium. Anything 1 to 5 on the risk rating is considered, good standing pass. Anything 6 to 9 is considered criticized, and obviously there's additional requirements for them from a reserve perspective, just regulatory pressure perspective on anything 6 and above. And as you can see from the chart here, and again, for those listening online, you don't get the benefit of the chart, but San Francisco leads the way in terms of number of properties with criticized loans above a 5 risk rating. Does that give us any insight into the future? Potentially. I mean, at some relative basis, risk rating should normalize and say anything above the threshold by definition is more risky, therefore is more likely to default. But it's not guaranteed that just because something is marked as having a higher risk rating or criticized that it doesn't pay off or that it doesn't get refinanced. And I think that's the challenge. I mean, Stephen alluded to the kick the can down the road. If you were here for the savings and loans crisis, there was a mantra, stay alive till 95. And we're starting to hear that again now, stay alive till 25. And so what we're seeing is lenders don't want these offices back. If paid professionals, that's their core business, is like managing, leasing, operating offices, are having a difficult time doing that, banks don't want to take that on because they're not going to do it any better. They're in the business of making loans, not operating properties. And what we've learned over the last couple of years is that, guess what? Institutional grade trophy office assets are super management intensive, and they cost a lot of money to maintain. And especially when you have to trade out tenants and you're white boxing and finishing out and doing all these TIs. We were on a discussion the other day where a large lease in New York, large office lease, 10-year term, one of the biggest leases that have been done in the last 24 months there, their break even after TIs and amortization is about year 5 on a 10-year lease. Now, the owner wants to get the 10-year term so they can try to get a refi in place and say their occupancy is this, their weighted average lease term is bolstered. But real economics, they're not making money until year 5 on the break even because they've had to offer so much to get the tenant there. So it's a completely different marketplace. If you're a tenant rep in today's market, there's not a lot of people wanting office, but the ones that do, you can do a really great job for them and get some really great incentives because the office owners are willing to give more on the front end to get that security of a longer term lease, more so now than they have ever before. We talked a little bit about delinquencies. So nationally, this is from our April delinquency report, offices at 2.77. But as Stephen mentioned, we anticipate that probably climbing above 4% in May. And I wouldn't be shocked if we start seeing that approach double digits here before the end of the year. I think we're going to see significantly more office distress, just as a function of the marketplace. If you have a maturity coming up and the lender is not wanting to work with you on refi, or they're asking you for a large capital contribution, your only recourse may be to not pay, to get them to the table to try to negotiate better terms. And so some of this is posturing. Some of this, though, is just driven by the market. At some point, tenants that have long-term leases in place that are at $70 a square foot, and sublease space in the building's being offered at 30, they have a decision to make. Are they going to continue to pay the rent every month, or are they going to just stop paying the rent and try to get better terms themselves? So you see this dynamic playing out. I mean, you've seen what's happened with Twitter, where they just stopped paying rent. We'll see if those, aggressive tactics work. They may not, but they may have some benefit to the people that are willing to take the risk. So we did look at some Bay Area loan maturities. So, kind of a narrative that we've seen broadly in the macro is nobody knows what the price of assets are at this point. If I had come to the Bay Area 16, 18, 24 months ago and asked anyone in the room, what's a typical Class A building in a, premier location going to trade for per square foot, everyone probably have a pretty good sense for what that value should be. Everyone can tell you what the going-in cap rate is. Everyone can tell you how they're underwriting these on a 10-year DCF. I don't know that everyone would have such a confident answer today if I asked the same question. What is a good stabilized occupancy for an office building in the Bay Area? What's a good stabilized occupancy for an office building anywhere in the U.S.? Cap rates have to have expanded. Interest rates have gone up 500 basis points. While not directly correlated, there is some correlation. This price discovery is not going to happen organically, because if you're an owner and you're cash flow positive, you're not selling in this market because you're not going to make any money. If you're an owner and you're not cash flow positive, the impetus to sell is not great because you're not going to make any money, but you may have no choice. But if you're an owner that's not cash flow positive and you have an upcoming maturity, that's what we call forced price discovery. And we have a lot of loans coming due over the next couple of years where we're going to see forced price discovery. I mean, at the end of the day, the lender's going to say, come to the table with cashinrefi.com money, or they're going to say, you got to pay the loan off or we're going to foreclose. And so we have some numbers here. So Stephen, if you want to just run us through some of the highlights here.
Sure. So 2023 is really one of the largest maturity years across asset types, with office standing out, unfortunately, like a sore thumb. So as Lonnie said, and I mentioned earlier about the maturity schedule by quarter, what will be critically important to this maturity schedule will be the price discovery that we'll get through loan sales and then revaluations on distressed assets. So it will take anywhere between 3 and 6 months to get in an appraisal, not a broker opinion of value. That's also another source of price discovery that you get, but it's less rigorous than a full-on appraisal. So it'll take about 3 to 6 months from the time that the loan becomes delinquent to when you get that price discovery. So just thinking ahead, we're not going to get really any sort of revaluations in size until this fall and winter that will really, I think, be impactful for determining how much risk is looming for 2024 and 2025. It's not going to be immediately apparent in these numbers in isolation, but I can tell you from the structured side, 2024, 2025 are even more material years for office maturity, loan volume in the securitized space, and in particular on the floating rate side, so that the single asset, single borrower, or SASB deals, in particular the ones that will be interesting to watch, because thus far into the cycle, what we've seen, and this is a term that I'll pull from the academic literature, a lot of times we'll say that the institutional investors will be ruthless in their default decision. And that's what we've seen play out over the last couple of months, and that some of the large players have just walked away, I think, quicker, or at least shown the willingness to, than what we might have expected. Whereas in the 2007-2008 crisis, it felt more as if the delinquency decisions were rolling up. This time around, it looks like they're rolling down from the institutional investors downward. But that's just for this early in the phase.
I think a lot of that can be attributed to the growth of funds and having allocations that they have to place capital, and office properties were a prime candidate for that because they could take large swaths of their allocation, apply it across 10 or 12 trophy assets in large cities, meet their requirements. Unfortunately, that market has been flipped upside down. And what this chart doesn't tell us, and what the narrative doesn't tell us today, is that kick the can approach. Guess what? Those maturities in 23 that get a 12 or 24 month extension, they become maturities in 24 and 25. So it's not like it's black and white where we say, oh, we've survived 23 and $11 billion of office maturities, we're just moving on to 24. Some of those will become residual in 24 and 25. So specifically in the Bay Area, we're looking at maturities here. I think we've talked a lot about maturities, so I don't want to belabor the point here, but the reality is there's a lot more pain to come. What we've seen right now is just headline. It's those institutional grade folks that have said we're going to walk away. Brookfields, the guys and gals that you typically wouldn't see associated with defaults and delinquency have been the ones leading the charge. What that's created is this inordinate amount of sublease availability in the marketplace. So there are certain sectors across the U.S. that have been impacted, considerably more than others. I still think, personally, this sublease market has not fully played itself out in terms of decreasing values or us seeing the full impact. It's just simple math in my mind. If contract rents are at $50, $60, $70 a square foot, sublease rents are at $35 a square foot or $45 a square foot, you now have a clearly delineated bifurcated rental market. And all those existing leases, when they roll, they're not going to renew at $65 a foot if sublease rents are at $35 a foot. Maybe they're not going to renew at $35, might be $50, but that $15 square foot delta, whatever the cap rate is a pretty large, hit to the value of the asset. And you do that at scale across a lot of these office markets. Minneapolis, as an example, they have over 3 million square foot of sublease availability right now. That's like a 10-year trajectory to try to lease that back up if office demand was what it was at historical norms. We're not anywhere near historical norms. In the Bay Area, large numbers of sublease availability. I saw something from the San Francisco Chronicle last week, it's like 18.5 million square feet of sublease availability. Maybe that gets leased up pretty quickly. I'm probably a little bearish on that. I think it's going to take some time. I don't know what the average lease size is, but if your average lease size divided into 20 million square foot, it's going to take some time. We're not talking about months, we're talking about years. And guess what? Those years are going to erode the rental values as well, because the rental rates are going to be lower or the TIs are going to be higher to get tenants to come to the space. And so you get this cyclical decline in valuations, not just transactional, where that building sold for less. You're going to start seeing system-wide type of diminished values.
We've been told that the interest rate gravity is here to stay for the long run. So absent a hard landing, if we believe that, one of the pressures that I see on the sublease side that probably won't abate is the tech sector and many companies could afford to lease space for their 5-year growth plan when rates were at the zero lower bound. But with rates higher now, and in particular, the productivity changes coming down the pipeline with AI and what that means for staffing needs and space needs, I think will be a very difficult headwind for absorption of some of that sublease space. Because it's just hard for me to believe that some of the large tech players that were taking down hundreds of thousands of square feet at a go will have that same view today, given that you can write code with Copilot, ChatGPT, and other things that basically mean you don't need as many of the junior analyst roles or junior coding roles that you did. So I think that's something that we're still very early on. But for Mark Zuckerberg to come out and say, this is AI has changed the game for our staffing needs at the junior level in a very material way, and we're cutting however many thousand jobs there. I think that's just a trend that we will see continue, and it has knock-on effects for office.
And we've seen them placate to the shareholders because they wanted to see them trim their expenses. And Google, Salesforce, Meta have taken like billion-dollar charge-offs on the real estate. I think I'm going to update my LinkedIn profile to say developer powered by ChatGPT. We'll see if that gets any traction in the marketplace. If you look at the occupancy, though, based on performing loans, weighted average occupancy is actually not as bad as what we would have made you believe today. Tenants are still paying the rent. So if you just close your eyes and don't look through the windows and see that there's no one in the office space, right? If you just look at the financials would indicate across most of these markets that loans are still okay. Tenants are still paying. The question is just for how long and what happens when those leases expire, because I don't think any of us have a real firm answer for that. So we've done some analysis for a lot of the large major MSAs. Some are performing better than others. DC, obviously, pretty decimated. Boston, pretty decimated. It just depends on how quickly people come back to the office, if they come back to the office. We may see just a new paradigm shift with office where office comes back, but it looks nothing like it did before. You're already seeing hotel amenities and other packages being put into offices. Retail's been able to reinvent itself with like this experiential retail. And so I think you're going to see a push for offices to become more experiential. I don't know what that means, because the offices you guys have here are pretty like experiential. It's like 5-star resort at the office. Like I would probably move in if they let me, maybe on a part-time basis, like an Airbnb at the Apple campus or something. If we could work that out, I'm a buyer for that too. But maybe, Stephen, pick a couple of the negative stories here and kind of walk through and maybe contrast that with what we've seen with some of the positive ones.
Sure. So tying back to the delinquency chart and comments earlier about the distress levels, well, if we're looking at the occupancy rates for, say, San Francisco in particular, right, you're still almost at 90% or mid-80s. We know probably the more realistic utilization rate is below 80%, around 78%, I think was the last stat I saw. So if we go over to the refinance analysis here, if you look at just the in-place cash flow for what we'll call an inflated occupancy, right, that's not what you would underwrite today if you were making a loan in San Francisco. You wouldn't be underwriting 90% occupancy. You'd be underwriting, something close to 80%, say. So ignoring that demand change, you have about 20% of the loans in San Francisco coming due within the next 18 months that if we shock the coupon up to a 6% interest-only term, 20% will have below a 1.25 debt coverage ratio. So that's before any sort of a value decline from higher cap rates, a value decline from lower underwritten occupancy rates. So realistically, you're probably looking at closer to a 40 to 60% stressed refi scenario for San Francisco, or even higher than that. Same thing for Washington, D.C. You have almost 38% at that 6% interest-only coupon that would fail that 1.25 threshold. And then New York, about 35%. And 6% might even be looking a bit optimistic, at least today. The weighted average coupon for some recent securitizations over the last month or two have been pushing 7%. So you can imagine how high that ratio will get if you get to that 7% level, if you layer on any sort of amortization, whether it's upfront or later in the loan term, and then also think about what's coming down the pipeline for revaluations. Some of these metros, the refinance pipeline is looking very, very difficult. So if we were to aggregate all of that up and think about the trajectory, to Lonnie's point earlier, double digits is very easy to see. I think the previous high for office delinquency was about 10.7% in December 2012, and about 20% of the office loans coming due in the next 18 months would fail the 1.25 threshold across the nation. So if you think about 50% of that might be able to recapitalize or get worked out, and the other 50% will be likely distress that has to work its way through. It's easy to get to double digits from there, just back of the envelope.
We did a couple of data analysis with one of our partner firms, CompStack, and looked at average lease term pre-pandemic, leases that were signed pre-pandemic versus post-pandemic. And what's really interesting is on the renewal side, you saw terms that were about 12% lower or shorter in duration post-pandemic than you did pre. So if you're in a building and you're looking for a renewal, you're renewing on average about 12% less for the term than you would have pre-pandemic. On new leases, though, it's less than a 1% change on the duration. The reason for that is because they get all these really fluffy incentives of TIs and everything else to get the duration. But on the renewals, you don't have that much pricing power on the landlord side. The tenants are opting for the shorter lease term. And you can see this broken out, and we're happy to share this information again. San Francisco in particular, it's way worse than the national average of 12%. On the renewals, you're looking at about a 30% delta to the shortening of those new lease terms. So the average lease term signed in 2020 would be about 42 months compared to a much longer term prior to that. And then if we look at just bifurcation of markets, we looked at in New York City and San Francisco here at effective rents by building age. And I think what we've seen, and this is a nationwide macro trend, we've talked about this on the podcast several times, you have this really clear segmentation in the marketplace. Everything that's Class A is still performing pretty well. If you're going to be in an office, you want it to be the best office and the best location with the best amenities. If you're in 1990s or 80s or 70s, functionally obsolete, small floor plates, low ceilings, not great amenities, you have some real challenges in the marketplace. Now, that potentially provides the opportunity for repositioning of those assets, potentially provides the opportunity for maybe some office to residential conversions. We've done some analysis on that. It's pretty difficult to do if you don't get the basis where it needs to be, which is pretty close to land value. But we'll see how that plays out. I mean, I think New York and San Francisco are definitely going to continue to stay on the radar, and you'll have first mover advantage here because you have such a high concentration of tech-used office space. And for the most part, the Class A stuff outside of San Francisco has actually maintained fairly well. San Francisco is maybe the one anomaly where you have high-end Class A space that have really taken the brunt of the fall because of the tech concentration.
Lastly, we do this on the podcast every week. We like to do a rundown of the headlines that we're watching on different property types. And we like to preface this by saying one singular story doesn't make a trend, but week over week when we start seeing subleases, vacancies, value reductions, we are able to make trends from them. So we pulled out some Silicon Valley stories here. I'm sure many of you in the audience might recognize some of these buildings and know them better than we do, but Lonnie, if you want to give a rapid fire rundown of some of these, we can go through them quickly.
Yeah, so this is rapid fire or start your engines or something like that. Headline here, San Francisco WeWork office value was cut by 2/3. So this was a property that had an appraised value, $28 million in 2014. Most recent bank appraisal was at $9.5 million. Not good at math, but that's not the direction you want to go. SKS Real Estate Venture is going to buy the Union Bank office building. This one's been in the headlines for some time. And I know you guys have some, insider info on this one, but effectively $250 million building in 2020, going to trade somewhere whispered between $60 and $67 million. Not great news. Great news for the buyer potentially, supposing that they can acquire it and actually get the building back to where it needs to be in terms of occupancy and operation. They have a lot better chance doing that in a $60 million basis versus $200. PSAI Realty Partners, $31 million purchase, about $230 a square foot for an office out in Sunnyvale. This is 350 Cobalt Way. Moving away from the office sector a little bit, we did have some multifamily property sales. So CIM Group paid about $143 million or just under $500,000 per unit for 1150 Clay, which is a 288-unit apartment complex in Oakland. And Speaker Living Trust paid $20 million or just over $330,000 per unit for 60-unit Midtown Court apartments in Palo Alto, California. Some general takeaways: the commercial real estate marketplace is resilient. The first thing you learn when you're in undergrad and you're taking real estate classes is that real estate's cyclical by nature. The government has intervened a lot over this last cycle, which has stretched a 7-year cycle to like 12-year cycle, but we're starting to see the downward side of that. It's going to get worse before it gets better in most cases. Visa is going to add more sublease space, and when Visa announces sublease space, it's not like 20,000 square foot. It's hundreds of thousands of square feet. Top tenant behind Presidio office is going to vacate. There's $240 million worth of CMBS loans against 600 California and San Francisco just defaulted. And then if you look in the Bay Area, there's been about 20 national credit-worthy tenants that have announced store closures or that they're vacating the area over the last couple of months. Most recently, Nordstrom's, which is going to close their San Francisco locations. And then we talked about this a couple weeks ago on the pod, put out a trading release on it, but T-Mobile had like a 19,000 square foot flagship store in San Francisco that they've decided to walk away from as well. So it's not just office, but I think the takeaway is just that the market's resilient. I heard in the networking part of this event this morning, a bunch of deal makers in the room. Like, the marketplace is going to heal. Rates at some point will stabilize. Commercial real estate can operate in high interest rate environments. Go back and look at the 80s. What they can't do is operate in uncertain times. So when interest rates were zero and they go up 500 basis points in 12 months and no one knows what the interest rates are going to be 6 months from now, you can't underwrite a deal that way. But if the Fed comes out and says, we're going to pause and this is going to be where we're at, guess what? You'll start seeing price discovery. You'll start seeing the market evolve. And so that's what we're hoping for. I think some of these headlines are kind of the precursor to that. You're going to see more of these office buildings trade at pennies on the dollar. But guess what? Go back to every other disruption or market cycle. That's happened. And so this is no different.
Before we turn it over, we wanted to give some shout outs. Today specifically, we wanted to thank Brett and Mark for bringing us here from South Bay Development. Firstly, for being loyal listeners, but secondly, for inviting us out here. Thank you to April and Cheska from the NAIOP Silicon Valley team for coordinating with us, and thank you all for tuning in and sticking with us as we do another live version of the podcast. And with that, we'll close. Thank you all for joining us today. Tune in next week as we look at what's happened during the week and how it may be impacting you. If you have questions, comments, or are looking for more, contact us at podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.